Good morning, everybody, and welcome to our November 2020 financial reporting update. So my name is Aletta Boshoff, and I'm a partner based in Melbourne, freshly out of lockdown, and I'm also the national leader for IFRS advisory at BDO. And now the presenters today is our IFRS advisory partner, Ashley Woodley, based in Perth, and also Associate Director Kay Kelly in Perth. And then we've got a guest speaker from tax, so that would be the smart person in the room, Gavin O'Neill, that is a senior manager in our corporate and international tax. So welcome to this financial reporting update, and we hope you find it really informative and helpful. I thought I'll use the opportunity to introduce our BDO IFRS advisory partners to you. You know Ashley, who's a partner in Perth, and she's also an audit partner in Perth. I said I'm Aletta. We also have Kevin Frobers, who's an IFRS advisory partner based in Sydney, and then Clark Gerald, an IFRS advisory partner in Brisbane, and Clark actually does quite a lot of litigation work as well. So across Australia, we've got 4 IFRS advisory partners. And if we then look at our broader team, altogether we've got 16 IFRS experts across Australia. And you would be happy to know that 4 of them are from WA. So you'll see Ashley, Kay Kelly, who's one of our presenters as well today. At the bottom, Inga Van Manen, and also Sunita Pop, who's been a long-serving associate director in our firm in Perth. Now, I thought I'll also use the opportunity to highlight some of the things that our IFRS experts are currently working on and quite passionate about. Recently, we've started working on how do boards and finance teams better manage their financial reporting risk. And we've used a app that you use on your mobile phone, 6 clicks, where we try to assess the risk appetite of boards and finance teams. We also try to assess, what items finance teams are more concerned about and what items boards are more concerned about. And as a result of that, we authored 3 different articles, and one of them was recently published by the Australian Institute of Company Directors. So I've put in some links to those articles. Some are on the AICD website, some are on our BDO website. What we have found is that boards seem to focus on the bigger picture, long-term issues, and in particular, things that would impact their brand. Whereas finance teams more focused on the new accounting standards, the detail, the new lease accounting standard, or if it's a not-for-profit, the new AASB 1058. And we did wonder whether we need some better communication or strategic alignments between finance teams and boards to align their financial reporting risk view of the world. I thought I'll also highlight some of the things that are definitely on the horizon. The first thing that's on the horizon in Australia is we're moving to general purpose financial reporting. And as you know, at the moment, it's a mixed bag of general purpose and special purpose financial statements. The AASB for the last 7-8 years have been working on removing special purpose financial statements and what that would mean. And at the same time, the AASB has recently decided to replace reduced disclosure requirements with the new specified disclosure requirements, and they've put it all together in one standard, AASB 1060, which for 31 December 2020 is the first time that it's actually available available. It's not mandatory yet, but it's available for early adoption. So in our webinar on the 16th of December, not long now, we will focus on this whole move to general purpose financials. So who would it impact? What does it mean? And we'll also look at these specified disclosures that are replacing reduced disclosure. This is definitely the next big thing happening in Australia. And you know, first cap of the rank would be for-profits, but I'm also part of a project advisory panel at the AASB where we're talking about when would this impact not-for-profits, and that's quite soon as well. The other thing that I would like to put on your radar, and in particular, I think in WA this is very relevant, and that is sustainability reporting. So there's been a lot of talk about how do we disclose the impact of climate change in our financial statements? How do we build it into our financial statements? Do we need an accounting standard that deals with this? And it's interesting that the International Accounting Standards Board, or actually the trustees of the International Accounting Standards Board, at a recent meeting considered whether we need sustainability accounting standards, and how are they going to make it happen, which body will issue that, and it looks as if it will be issued by the International Accounting Standards Board. So sustainability reporting, important to keep your eye on that, and to start to think how you incorporate that in your financial statements. The other one, and this is an old one that's back, and that is about goodwill. So should we amortize goodwill over a period of time, or should we keep goodwill as a result of a business combination on the balance sheet, not amortize it, but instead do an annual impairment test? Now, I think when I first qualified way back when in South Africa, goodwill was amortized. And I think we amortize goodwill usually standard over 5 years, but you could come up with some justification to do it over a different period of time. And then when the new IFRS 3 came in, we moved away from the amortization of goodwill, but it's back on the cards. And there's a discussion paper that was issued earlier this year asking the question, what do we do with goodwill, to amortize or not? So just another one to be aware. It's lurking. Now, this one is an interesting one, IFRS 17 around insurance contracts. Now, many people have turned a blind eye to the latest standard because they would say we're not an insurance company. Now, I would say, IFRS 17 does not only apply to insurance companies, but it applies to any situation where you've got an insurance contract. So important to assess that. This standard has been issued quite a while ago, but it's only effective for years beginning on or after 1 January 2023. But there's a lot of work to get ready for this one. So again, just something to consider. Would this potentially impact your business? Then I would like to flag some initiatives that we have at BDO to keep all our clients and our contacts up to date with all the latest developments in accounting standards. Now, you might be aware of our accounting news, and there's a link to the September accounting news, but you'll see the header. I've taken that from the November accounting news that was issued on Monday. So we've got an accounting news. This publication is pure gold. Even before I joined BDO 4 years ago, and I was a technical director at another firm, I subscribed to the BDO accounting news because it was always so practical, so relevant, so up to date, and easy to read. So I would highly recommend that you maybe look at that YouTube video explaining a bit of what we have in the newsletter. Register for this accounting newsletter, very useful. And you can see in the November one, we've explained, JobMaker, the hiring credit that's announced in the federal budget. How do you account for that? How does COVID-19 impact not-for-profits? We talk about non-refundable R&D incentives. We even talk about the extension of the reporting deadlines for 31 December 2020. So this is really up-to-date information. Then we also have an IFRS training hub. Now, our training hub is really to keep you up to date with everything that's going on. And in that training hub, I think it's on the next slide, in particular, we have complimentary monthly webinars. So you can register for these webinars, 12 one-hour webinars, one every month. You get CPD certificates. And similar to the accounting news, we include the latest and the greatest, so you know exactly what's going on. And we love to include other partners from other service lines. So we had corporate finance join us to come and talk about how do you determine incremental borrowing rate for lease accounting purposes. We've had some of our tax partners come and talk about contract compliance. Talk about remuneration, the impact of remuneration on financial statements, etc. So we love to get them involved to give you a well-rounded view on what's going on in accounting and related areas. So please register for these webinars. The invitation for these monthly webinars will be going out within the next week or two, and we usually send out all the invitations for the rest of the year in one big bang. So please look out for those. But in addition to the complimentary webinars and complimentary accounting news, we also have virtual workshops that's been run on Zoom where we look at detailed case studies. We had one yesterday. And you can register for these. We've got another one coming up in 2 weeks' time where we look at corporate transactions if you want to give it a try. Corporate transactions where you might have a 40% interest in an entity, you buy another 20%, now you have control. How do you account for that? Or you have a subsidiary and you sell a part of your interest and now you have joint control, or now it's an associate. How do we account for all of that? So virtual workshops, practical case studies. And then finally, the question, are you audit ready? Now, a big thing that we do in IFRS advisory, so we're not part of audit, we sit in advisory, is we help our clients to be ready for the audit. So we put position papers together with them. We review financial statements. We often do lease accounting using BDO lead. So we assist in various ways to make sure that by the time your auditors arrive, you are ready, and hopefully it takes a bit of the stress away during the audit. So I've included a link there to where we explain our audit-ready services. I think finally, I would say, from an IFRS advisory perspective, we are really lucky to have Ashley, Kay, and the rest of the team in Perth working with us nationally. We're a very close team. We meet at least once a week where we talk about issues, and we work together to keep all of our clients informed on the same page. Please feel free to reach out to any of us if we can help you in any way. But I hope you enjoy the rest of this webinar and you find it very informative. I'll hand over to Ashley.
Thank you, Aletta, and good morning, everyone. So the rest of the session this morning, we're going to discuss the ongoing financial reporting implications as a result of the coronavirus pandemic, as well as touch on those standards and interpretations which have only recently been adopted or are being adopted this year. As Aletta mentioned, we will then follow this with a short update on tax presented by Gavin O'Neill. As we go through the presentation, please feel free to raise any questions via the question box and we'll try to address them as they arise. Otherwise, we will respond individually to any questions we don't get through today. So the implications of the coronavirus pandemic around the world. When we last presented an accounting update 6 months ago, there was an awful lot of uncertainty around what would happen both in Australia and globally, and what this would mean for the economy. Well, 6 months on, and we have been very lucky here in Perth, and a vaccine may be on the horizon, but there remains a lot of uncertainty around the world, including as to the longer-term impacts on the economy, how fast and what shape will the recovery be. Our advice last time was that all the uncertainties should lead in your financial reports to increased disclosures. And I think the same could be said at December. Disclosures around judgmental areas will continue to be very important. We're also going to look at what next post-implementation for AASB 16 and also other newly adopted or soon to be adopted standards. So turning to our first topic, impairment. When we think of impairment, we first think of the standard on impairment of non-financial assets, AASB 136, and then also AASB 9 in relation to the impairment of financial assets. AASB 136 applies to PP&E, intangible assets, and possibly for the first time, right-of-use assets recognised under the new leasing standard. And for financial assets, AASB 9 contains the impairment requirements for these, but also for contract assets recognised under AASB 15, and also financial guarantee contracts and loan commitments. It's also worth remembering that impairment needs to be considered in relation to other standards as well, even if it is not described as such. For example, inventories, associates and joint ventures where there are a number of impairment-related considerations, and income taxes, in particular the recoverability of deferred taxes. So what is ASIC expecting in terms of impairment? ASIC's recent media releases emphasise the importance on focusing on asset values in these uncertain times. Specific guidance released from ASIC states that given uncertainties, it may be necessary to use probability-weighted scenarios in making estimates of both fair value and value in use. In those cases, modelling risks may still need to be factored into the discount rate used in a discounted cash flow model. For financial assets, ASIC advises that past models and historical experience may not be representative of current expectations. This applies to all loans and receivables, including loans to associates and trade receivables. A probability weighting of possible scenarios may also be needed in these assessments. And ASIC's key message, clear disclosure around the business impacts and uncertainties is vital. Looking now at AASB 136 and when we are required to test non-financial assets for impairment. Goodwill and indefinite life intangibles must be tested for impairment at least once a year, and other non-financial assets whenever there is an indicator of impairment. For those of you with a June year end, chances are impairment testing was undertaken during your June reporting period. The challenge now is to see how the assumptions made during such an uncertain time have stacked up. If plans have not panned out as expected and economic performance of a certain asset or group of assets is worse than expected, then this is an impairment indicator that will require you to conduct another impairment test. Or alternatively, if impairment was recognised in the June year end and the actual performance is better than expected, a reversal of the impairment may be required. Noting that reversal is not allowed for any previously impaired goodwill. For our December year-end entities who are not required to report on their half year at June, this is likely to be the first time you are required to factor COVID uncertainties in your reporting. Given the significant changes in the environment since last December, it is likely that external and/or internal impairment indicators are present and impairment testing will be required. This slide includes other impairment indicators that are particularly relevant in times of uncertainty. And of course, paragraph 12D, which we come across a lot, if you are listed and your market capitalisation is less than your net asset position, This is an indicator that you need to look at your asset values and test them for impairment. So when is an asset impaired? Well, when its recoverable amount, being the higher of its value in use and its fair value less cost of disposal, is less than its carrying amount. In this situation, the asset must be written down to its recoverable amount. And if the asset is being tested as part of a CGU, then the overall impairment loss must be allocated to the assets within the CGU, starting first with intangibles. Cash flows included in either value in use or fair value less cost of disposal calculation need to consider all available information. Given the disruption to operations, the cash flow forecast will need to incorporate extremely severe downside forecasts, and the effect will vary depending on industry sector. Turning now to financial assets, expected credit losses may increase due to an increase in both the probability of default and the loss given default for financial assets. As all financial assets subject to expected credit losses require the probability of default to be estimated over the next 12 months, the effects of uncertainty relating to coronavirus may be very significant. Additionally, the effects of the coronavirus may trigger a significant increase in credit risk, particularly if your customer base is international, and therefore the recognition of a lifetime expected credit loss provision on many financial assets. For equity accounted investments, before applying the equity method, an entity must first recognise expected credit losses in accordance with AASB 9 if an investment in associate or joint venture includes a long-term interest that is subject to expected credit loss, for example, a loan to the investee. After an investor has recorded its share of income from an associate or joint venture, as required by the equity method, the remaining carrying value of the investment is still subject to further impairment requirements. An entity applies AASB 136 to the remaining carrying value. After the carrying value of an interest in an associate or joint venture is reduced to zero, additional losses and a liability are accounted for if the investor has a legal or constructive obligation to make payments on behalf of the associate or joint venture. The effects of COVID-19 may make this type of arrangement more common. For deferred tax assets, an assessment of the likelihood of an entity being able to recover the value of deductible temporary differences needs to consider all available information. Tax losses and other deductible temporary differences having no fixed expiry or a very long-term expiry is not justification for the recognition of associated deferred tax assets. Our concluding comments on impairment are that we still expect an increase in the number of assets and CGUs that will require impairment testing. Multiple scenario analysis is still likely to be the most accurate way to reflect future cash flows, and enhanced clear disclosures are vital. I will now hand over to Kay, who will take you through modification to leases and share-based payments.
Thank you, Ash, and good morning, everyone. Turning now to an area where the IASB, and subsequently the AASB, has made changes to an accounting standard in response to the coronavirus pandemic. Barely was the ink dry on the first-time application of the new leases standard, then it has been amended. And this was in large part due to the newness of the standard. The IASB recognised that the first-time adoption had been challenging, as many companies struggled to assess their many and diverse lease contracts. Add to this a global pandemic, resulting in government intervention around the world, either forcing or enabling landlords to provide rent relief in some form to tenants, and there was no time for anyone to catch their breath and indulge in a little bit of a steady state. Instead, they were being asked to consider how to account for changes to their lease contracts. And whilst the initial response might be, well, the agreement has been changed, that is, it has been modified, so there must be a lease modification to account for. Things were, of course, not that simple. What if the lease contractor had foreshadowed changes to the lease payments in the event of a force majeure? Was there a lease modification then? And was the global pandemic a force majeure event? Now, if you only have one or two leases, it may not be too hard to answer these questions. But if you have many leases, all with different terms and conditions, you can see the amount of work to assess this rapidly multiplies. Recognising this, the IASB made amendments to IFRS 16, AASB 16 in Australia, to add a practical expedient to allow entities to shortcut their way through this analysis. But before we look at how the practical expedients works, let's first look at what the implications on your accounts may be if you do or don't use it. If the practical expedient is not applied and the rent concession, for example being the deferral or reduction in rent, is a lease modification, that is, it was not in the original terms of the lease, but does not decrease the scope of the lease, then the lease liability will be remeasured to be the present value of the revised lease payments using an updated discount rate. An equivalent adjustment is made to the right of use asset. This means there is no immediate impact on profit and loss, and the effect is instead recognised through modified interest and depreciation going forward. Consider now the impact if the conditions for the practical expedient are met and it is applied. The lease liability is again reduced to reflect the revised lease payments. However, the discount rate used to calculate the lease liability is not updated. The original discount rate continues to be used. Assuming the rent concession is beneficial to the lessee, this will also result in a reduced lease liability, although the quantum of this will not be the same as with lease modification accounting because of the different discount rates. The other side to the adjustment to the lease liability, if the practical expedient is being applied, is not to the right of use asset. Instead, it is to profit and loss. Depending on the facts and circumstances, this can be either immediately or over the period of the rent concession. This flowchart shows the conditions that need to be met for the practical expedient to be applied. Firstly, did the rent concession occur as a direct result of the COVID-19 pandemic? If not, then the practical expedient can't be applied. If it did, then the next thing to consider is whether the change in lease payments has resulted in consideration that is substantially the same or less than before. Now, the standard isn't clear whether, in assessing this, you should use nominal, that is undiscounted, lease payments or discounted amounts. In our view, it would be appropriate to use discounting. As an example, if a rent concession defers 3 payments of monthly rent of $100 for a period of 12 months, and the lessor and lessee agree to increase the rent to, say, $105 per month when it is paid in 12 months, then provided this increase is only to compensate the lessor for the time value of money, then this criterion is satisfied. You then need to consider which payments are affected. How far out does the rent concession go? And note that if the concession goes out beyond June 2021, then the practical expedient can't be applied to any of the rent concession. That is, you can't split it and apply the practical expedient to rent reductions before June 2021 and lease modification accounting to rent reductions after that date. Then you also need to consider what else, if anything, has changed in the terms and conditions of the lease. For example, has the term been extended, perhaps to compensate for periods during lockdown when the asset could not be used? This was considered by the IASB whilst they were drafting the practical expedient, and the example they gave was that of a 3-month rental holiday before 30th of June 2021, followed by 3 additional months of substantially equivalent payments at the end of the lease. They concluded this would not constitute a substantive change to other terms and conditions of the lease. And finally, if you are going to apply the practical expedient, it needs to be applied for all similar leases. So, assuming you can and choose to apply the practical expedient, what do? Well, it simply states that the rent concession is not accounted for as a lease modification. This will often result in changes in lease payments being accounted for as variable lease payments through profit and loss. The timing of when this is recognised will depend on the precise terms of the rent concession. For example, if the rent concession agreed is that rent for the period from July to December 2020 will be reduced by 15%, and this reduction is not conditional on any future events, then the benefit will be recognised in profit and loss when the concession is agreed. Conversely, if a landlord and retailer agree to a 15% reduction in rent for each of these months, but only if foot traffic in the shopping centre is down 15% on the prior year, then the benefit will only be recognised over the period July to December, once it is confirmed that foot traffic is reduced. And if you choose not to or don't qualify for the practical expedient, well, as I said before, the first thing is to consider whether the rent concession is a lease modification or, if the lease contained a force majeure clause which covers a pandemic, a lease reassessment. If the rent concession is accounted for as a lease modification, then the normal rules in AASB 16 will apply. That is, if the modification gives rise to an increase in scope and the consideration changes by an amount commensurate with the standalone price, then the modification is accounted for as a separate lease. If the modification otherwise gives rise to an increase in scope, or the scope of the lease is unchanged, then the lease liability is remeasured using a revised discount rate, and the right of use asset is just adjusted by the same amount. And if the scope of the lease decreases, for example, if the floor area leased is reduced, then both the lease liability and the right of use asset are decreased, which will have an immediate P&L impact, and then the lease liability is remeasured. And if you want to know more, there are a number of BDO publications. The links are on the slides, which will be made available after the webinar today. Next, I'm going to touch briefly on share-based payments. I'm going to look at the accounting for the situation where you have modified the terms of an equity-settled share-based payment arrangement, and also the situation where you haven't modified the terms, but your expectations as to whether rewards will vest has changed. The first scenario to consider is where a company makes changes to equity-settled share-based payment awards that have already been granted. This could be through changing the terms of an existing award, or if an existing award is cancelled and replaced with a new award, and where this is designated as a modification. A word of caution here though, replacement awards need to be formally designated as replacements to qualify for modification accounting. Otherwise they will have to be accounted for as a cancellation of the old award and a separate new award. So I would suggest you talk to your advisors here and ensure that all the I's are dotted and the T's are crossed. But assuming modification accounting is achieved, then the accounting treatment depends on whether the fair value of the modified award is higher or lower than the fair value of the original award, noting that both these fair values are measured as at the date of modification, not the original grant date. If the fair value of the modified award is less than the fair value of the original award, then, unfortunately, you don't get to reduce the expense to be booked. The grant date fair value of the original award is still what is recognised, noting that, because of the modification, the vesting period may have changed. In particular, if any awards have been cancelled, then any remaining expense in respect of these must be recognised immediately. But if the fair value of the modified award is higher than the original award, then, as well as the original expense, there is an additional expense to recognise, being the difference between the two fair values. Again, if the modification has changed the vesting date of the award, then this needs to be factored into the accounting entries. With regard to modifications, a final point is with regard to awards that have already vested with an employee. That is, the full original AASB 2 expense has been recognised. Perhaps surprisingly, if these awards are modified before they are exercised, there may also be an expense to recognise. As with unvested awards, an expense is recognised if the modification increases the fair value of the award, measured at the date of modification. It may be, of course, that you haven't changed the terms of your share-based payments. Just to recap on what to do if your expectations as to whether they will vest has changed. For awards with service or non-market performance conditions, if the service conditions are not met, then forfeiture accounting is applied, and any expense previously recognised is reversed through profit and loss. Conversely, if an award only has a market performance condition, then the expense is recognised whether or not the condition is satisfied. For awards with multiple conditions, it is a little more complicated. If an award requires both a service condition and a non-market condition to be met, if either is not met, then the expense is reversed. And if an award requires both a service condition and a market condition to be met, then if the service condition is not met, the expense is reversed. But if the service condition is met, and it is only the market condition that is not, then the expense continues to be recognised. The same would be the case if an award requires both a non-market performance condition and a market performance condition to be met. The expense is only reversed if the non-market performance condition is not met. And if an award requires either a market or non-market condition be met, then, assuming any service conditions are met, at a minimum an expense will be recognised for the grant date fair value of the award, adjusted for the likelihood of the market condition being met, whether or not either performance condition is met. But if the non-market performance condition is met, then the full grant date fair value needs to be recognised. Now I'm going to hand back to Ash to talk about going concern.
Thanks, Kay. So to touch on going concern, at our accounting update in June, we were facing a world of significant uncertainties, and as such, there was a big focus on going concern. I won't go into too much detail here as the June webinars are still available, but I do want to highlight that even though we generally have a greater understanding of the pandemic, the environment is still ever changing and the going concern assessment is still critical. As we enter another period of change with the end to many government stimulus measures and protections, your going concern assessments will need to take these factors into consideration. We still need to consider how our major customers are impacted. Are they likely to survive once government assistance is reduced? Are capital markets likely to restrict? And will there be further disruptions to supply chains? In addition to this, the temporary safe harbour defence that was introduced in March this year ends on 31 December 2020. This temporary safe harbour for directors from civil insolvent trading liability is basically a blanket protection across the board. Once this ends on 31 December, there is uncertainty around how a director will take advantage of this temporary protection, and directors need to start preparing for this. Very relevant to the going concern discussion is the determination of assets and liabilities as current or non-current. The classification of assets is based on expectations, whereas for liabilities, it is based on rights. Changing times may mean classifications need to be revisited. The classification of liabilities as current or non-current is as topical as ever and still a key focus for ASIC, with ASIC regularly releasing media statements where companies have been required to restate liabilities from non-current to current. In addition to this, the IASB has deferred the amendments to IAS 1 relating to classification of liabilities. Originally due to be effective for annual periods commencing on or after 1 January 2022, the new requirements will only apply from 1 January 23. However, in deferring these amendments, the IASB did note that the amendments clarify but do not fundamentally change the classification requirements. So looking at this amendment, I will highlight the key changes coming into effect. Firstly, the reference to unconditional rights has been removed from paragraph 69D because rights to defer settlement are rarely unconditional. They are often conditional upon compliance with covenants, as an example. Secondly, new guidance has been added in paragraph 72A to clarify that if a right to defer settlement is subject to the entity complying with specified conditions, the right exists at the end of the reporting period only if the entity complies with those conditions at the end of the reporting period. The amendments to paragraph 73 result in classification which is based on the right to defer settlement and not intention. And new guidance in paragraph 76B clarifies that the exception to ignore early settlement options only applies to bonds where the conversion feature is classified as an equity instrument under IAS 32. When classifying convertible bonds or notes with conversion features classified as liability or a derivative liability, entities cannot ignore early conversion options. In future, we could see convertible notes being classified differently in the financial statements, depending on whether the conversion feature fails the fixed criterion for equity classification. So as a reminder, even though these changes are not effective until 2023, these amendments are meant to clarify the current standard, and so the above points should be considered when determining the classification of liabilities. Okay, I will now hand back to Kay to discuss modifications to financial instruments.
I spoke earlier about modifications to leases and share-based payments, expecting that, in this changing world, companies may have made changes to these. Another area where modifications are likely to have occurred is around financial instruments. Lenders and borrowers may enter into agreements to modify the terms of financial instruments such as bank loans. These modifications may take the form of reduced interest rates, modification to payment terms, and grace periods for covenant violations. Entities need to consider the requirements of AASB 9 for the modification of assets for lenders and liabilities for borrowers. These modifications will generally give rise to gains for borrowers and losses for lenders. Perhaps more likely is that you will have modified your financial liabilities. The accounting depends on whether the modification is substantial or non-substantial. AASB 9 states that a modification is substantial if the discounted present value of the cash flows under the new terms, including any fees paid net of any fees received and discounted using the original effective interest rate, is at least 10% different from the discounted present value of the remaining cash flows of the original financial liability. The guidance for the treatment of the modifications of financial liabilities that are non-substantial and so do not result in derecognition is unchanged from AASB 139. Accordingly, if a modification of a financial liability does not result in derecognition, any costs or fees incurred are recognised as an adjustment to the carrying amount of the liability and are amortised over the remaining term of the modified instrument by recalculating the effective interest rate. But if the modification is substantial, then the old liability is derecognised and a new liability is recognised, with the effective interest rate being calculated based on the revised terms. Any costs or fees incurred are recognised in profit or loss as part of the gain or loss on extinguishment and do not adjust the carrying amount of the new liability. And to finish this part of the presentation, a couple of points in relation to JOBKEEPER based on some of our recent experiences. For for-profit entities, the accounting for JOBKEEPER payments is governed by AASB 120, which requires the grant income to be matched against the related expenditure. AASB 120 is an old standard which continues to apply the matching principle. As a consequence, where salaries have been capitalised into the cost of assets such as inventories, PP&E or intangibles, the JOBKEEPER grant income for those capitalised salaries must be deferred and recognised as income during the periods when the related salary costs are expensed, that is, as cost of goods sold or depreciation or amortisation of PP&E or intangibles. This can be done by deducting grant income off the cost of the asset or by setting up a deferred income account. So, turning away from coronavirus now and to new accounting standards and developments, a big sigh of relief. Over the past couple of years, you've successfully implemented the new revenue standard, the new financial instrument standard, and finally, the new leases standard. So, what's next? Well, you may not want to hear this, but AASB 9, 15 and 16 aren't over yet. Transition is just the first step. Next, you need to manage these new standards on an ongoing basis. As Wayne used to say, systems and processes, systems and processes. Today, I'm going to focus on AASB 16. Earlier, I spoke about the changes to leases as a result of coronavirus and how these are accounted for. Well, that may be special circumstances this year, but there will always be changes to your leasing portfolio, whether that is adding new leases as older ones close out, or making changes to your existing leases due to changes in circumstances. All of these changes will need to be monitored and accounted for. This slide identifies the various changes that can occur and how they are accounted for. Highlighted in red are those changes that will result in an immediate P&L impact, although any change to the lease liability and right of use asset will obviously result in changes to depreciation and interest expense going forward. Determining the appropriate accounting treatment will depend on what has changed. Has there been a new lease, or has an existing lease been terminated or modified? And for a lease that has been modified, is there truly a modification? That is, has there been a change in the contractual terms? Or is it that circumstances and expectations have changed, but within the context of the original agreement? The accounting then follows on, depending on the nature of the change. Other than those changes with an immediate P&L impact, the approach is to remeasure the lease liability based on the revised lease payments and adjust the right of use asset by the same amount. And as we all know, the lease liability is calculated as the present value of the future lease payments. But in doing this, should we use the original or a new discount rate? You will see that some of these changes require using the original discount rate, while others require use of an updated rate. I think it's worthwhile touching on a few principles here. If you have made a new economic decision, such as entering into a new lease or renegotiating the terms of a lease with the landlord, then that has been done in the current economic environment, so it makes sense to use a current, that is new, discount rate. Similarly, if you have determined the lease term has changed, that is how long you are reasonably certain to lease the asset for, that determination will have been made now, and so a new discount rate should be used. Although here it's also worth noting that an updated discount rate is required because the lease term has changed and, all other things being equal, the discount rate will change, the same as how the rate on 10-year government bonds is different to the 1-year rate. But conversely, when you haven't actively changed anything, for example, a lease agreement always contained rent increases based on CPI, it's just this only becomes known now, then the original discount rate is used because you have just maintained the status quo. You haven't made any new decisions. So we understand the accounting and why it is what it is, but there remains the question of how to manage this. Things to think about and ensure that you are addressing include: does your finance team have the necessary capacity and required level of knowledge of AASB 16 to maintain the accuracy and validity of inputs into your lease accounting solution, whether that be Excel or a software solution? In particular, if you have lots of leases and they are consistently changing, then in particular with Excel, is your version control good enough? Next, as discussed on the previous slide, the accounting will depend on the nature of the change. Is your finance team across the difference between these and the accounting consequences? What about new leases, those that may come into a business combination as well as in the ordinary course of business? How easily can you set up the accounting for these? And for new contracts, not just leases, does your team have the capacity and knowledge to assess these and identify any embedded leases? And even before this, will they be aware of all new contracts entered into by anyone in your organisation that may contain embedded leases, so they even know to look? Transition made determining the discount rate to be used easier. If you were using the simpler modified retrospective method, then you just needed to determine the discount rate at transition date. But going forwards, leases will continue to be entered into. Do you have a process to update your calculations of what this discount rate should be? Month-to-month leases also continue to provide challenges. Whilst the legal commitment may be only a month, if the lease term, being how long you are reasonably certain to lease the asset, is more than 1 year, then the short-term lease exemption can't be applied. And again, does your team have both the capacity and ability to ensure all month-to-month leases have been identified and appropriately analysed? Now, hopefully you can answer yes to all these questions, or alternatively, they may be providing some food for thought. Most likely is there may be areas where you may need assistance, and a little reminder about our services here, whether that is BDO Lead, our software solution to manage the ongoing lease calculations and journals, and that we are able to offer to clients with many leases or with only a small number of leases, or IFRS advice and assistance in analysing your contracts and leases. So that's one recently adopted standards. In terms of new standards, Ash is now going to talk through the new changes to AASB 3 and also recap on Interpretation 23.
Okay, so Interpretation 23, which was effective for the first time for June 2020 year ends, and I would say this new standard probably didn't get the attention it needed given everything else impacting the June financials. So I will provide a brief reminder on what has changed. IFRIC 23 is a measurement standard that deals with the calculation and recognition of uncertain tax provisions. IFRIC 23 does not deal with the actual computation of current and deferred tax, which is still covered by AASB 112. And it's also interesting to note that the IFRIC did not include guidance on accounting for interest and penalties associated with uncertain tax positions, which can be a common issue. Sometimes the interest and penalties could become more material than the actual underlying tax itself. IFRIC 23 does not address how an entity should account for the interest and penalties on taxes that may eventually arise relating to an uncertain tax position. However, it should be noted that the basis for conclusions to IFRIC 23 provides some guidance on this issue. the basis states that interest and penalties that are deemed to be income taxes would be within the scope of IAS 12 and therefore IFRIC 23 as well. Determining whether interest and penalties are income taxes in the scope of IAS 12 depends on whether they are based on taxable profit, as this is a key aspect of the definition of income taxes. On this slide, we have a graphical representation of what types of uncertainties IFRIC 23 requires measurement of. On the top axis, we have the probability that a tax position will be accepted by the taxation authority. If the probability is more likely than not, i.e. greater than 50%, then IFRIC 23 does not apply. So if IFRIC 23 does not apply, then that position is used in computing the underlying tax balances for current and deferred tax. Applying this to a simple situation, if an entity believes it has a 99% chance of being successful in a very basic, non-controversial tax position, then that 1% of uncertainty does not have any measurement implications. On the contrary, if a position is not likely to be accepted, then the extent of that uncertainty is included in the measurement of the tax position, affecting the calculation of current and deferred tax. For example, if an entity filed a tax return which included a tax position concerning the taxability of certain revenue streams, and it was concluded that the filing position only had a 20% chance of success, then the current tax provision per the financial statements will not match the current tax liability as filed in the tax returns. IFRIC 23 mandates that the calculation of uncertain tax positions must be on the assumption that the tax authority has full and complete knowledge of your tax matters, and the concept of detection risk is not permitted to be included in the calculations. Paragraph 8 states that an entity shall assume that the tax authority will examine your books and records. At the end of the examination period, when the position is no longer uncertain, the provision is released to the P&L. In terms of disclosures, IFRIC 23 does not introduce any additional disclosures, however, it does emphasise some existing disclosures, particularly around judgments, including how your underlying interpretation of certain tax legislation. And it is worth noting in relation to tax-related contingent assets and liabilities, AASB 137 would still apply even in situations where under IFRIC 23 an entity has concluded that the uncertain tax position is probable to be accepted. For example, assume an entity concluded a tax position was 55% likely to be accepted and therefore the uncertainty was not measured under IFRIC 23. AASB 112 might still require disclosure if the effect of it not being accepted would be material. Moving now onto the new changes for this reporting season. And the good news is that there aren't many. The key change this period is the amendment to AASB 3. After considering feedback from its post-implementation review of the business combination standard, the IASB recently made amendments to the definition of a business in IFRS 3. The new definition must be applied to acquisitions occurring on or after the beginning of the first annual period that begins on or after 1 January 2020. So entities with December year ends will therefore be required to apply the new definition to acquisitions that have occurred this year, and those with June year ends will be required to apply it to acquisitions that have occurred since 1 July this year. Distinguishing between an asset acquisition and business combination is important, as assets and liabilities associated with the transaction are accounted for differently, depending on whether the transaction is a business combination or an asset acquisition. Some of the differences include the treatment of goodwill, where there is no goodwill on asset acquisitions, In relation to deferred taxes, for asset acquisitions, the recognition exemptions apply, so no requirement to recognise deferred taxes. And the treatment of transaction costs, which are expensed when dealing with a business combination but capitalised under asset acquisitions. So what changes have been made? In summary, the amendment makes it easier to get to the conclusion of an asset acquisition, with the key change being the clarification that to be considered a business, an acquired set of activities and assets must include, as a minimum, an input and substantive process that together significantly contribute to the ability to create outputs. The amendment also introduces an optional concentration test as a shortcut way of concluding that certain types of acquisitions are not business combinations. The concentration test allows a simplified assessment of whether an acquired set of activities and assets is not a business. In other words, this is the shortcut way of concluding that the acquisition is not a business without having to conduct the detailed assessment required by AASB 3. In applying the concentration test, paragraph B7b includes extensive guidance about what can be considered a single identifiable asset or similar assets. The concentration test is optional and it can be applied to some acquisitions and not others, i.e. it's a separate election for each acquisition. Onto some more good news. Earlier last week, ASIC issued an extension for reporting deadlines. ASIC have noted that due to the disruptions still ongoing from the pandemic, some entities may still experience difficulties in meeting reporting deadlines and therefore have granted a 1-month extension. The last 2 bullet points on the screen are the key ones. If you are a foreign registered entity, these extensions do not apply to you, which is the same case as was at June. And if you're a listed entity, the fact that ASIC has granted an extension does not necessarily mean that the ASX will also grant the extension. For 30 June, they did end up doing the same through issuing a class waiver. This is not in place yet, but we would expect the ASX will follow. It is also important to note that ASIC did highlight that where possible, it's important to try and stick with the original reporting deadlines. Okay, and finally, another recent change that I would like to bring to your attention that will indirectly affect preparers of financial reports. This is the significant revision to the auditing standard ASA 540, which is auditing accounting estimates. We would like to make you aware of matters to consider in preparing for and responding to your auditor's requests pertaining to their audit of estimates and related disclosures. This standard will be applicable to audits with 31 December 2020 year ends and on. The standard focuses particularly around the auditors really understanding the process and controls in order to understand what drives the risk of material misstatement of an accounting estimate, how they apply professional skepticism, looking for indicators of possible management bias, and how they challenge assumptions used in calculating estimates. So you should expect greater scrutiny and questioning of your accounting estimates from your auditors. Preparers will need to brief audit committees on significant accounting estimates, as these are often complex areas of the audit and need to be reported appropriately and robustly challenged. So on that happy note, that ends the accounting updates. Gavin will now provide a tax update, and then time permitting, we can run through any questions at the end. Over to you, Gavin.
Thanks, Ashley. Okay, good morning, everyone. My name's Gavin O'Neill. I'm a Senior Manager here in the Corporate and International Tax team at BDO in Perth. And yeah, just want to run through a few of the key updates that we're chatting with clients about at the moment that have been released in the most recent federal budget for 2021. as you can see there, these include the loss carryback rules and the immediate deductions for capital expenditure. And then I'll finally just touch on the next stage of the ATO reviews that they are undertaking, now known as the Next 5000 program. Okay, so the first one here is the loss carryback rules. So some of you may recall these rules being around quite a number of years ago now. So they've been brought back as part of the COVID response from Treasury. Essentially what it allows is for businesses who have paid tax in the 2019, 2020 and 2021 income years, if you've incurred a loss subsequent to that, so in the 2020, 21 or 22 years, then you can use those losses to offset the tax paid previously. This can generate a cash refund for taxpayers to help your business and help stimulate the economy. It applies to quite a broad range of businesses, so your turnover below 5 billion. So that captures a large percentage of the corporate taxpayer base. Some limits do apply though. Losses carried back obviously cannot exceed tax paid and the taxable profits that a business has paid. And also, if the business has paid out fully franked dividends, you cannot, I guess, result in a refund where your franking account will be in deficit. This next table, this is a bit of a summary of the sort of changing landscape of the immediate capital deductions that we've had over the last 12 months or so. Now, this is key because during your 2020 compliance and compliance for the 2021 years, there's going to be a number of important dates with different thresholds to consider when assessing your capital expenditure on depreciating assets. Now, so essentially what this is about is businesses who incur costs on depreciating assets through the 2020 income year and beyond, you'll be able to claim immediate deductions for those depreciating assets up to certain values in cost. So as you can see here, up to the 11th of March, there was a lower threshold, so an immediate deduction for small and medium businesses up to $30,000. That was subsequently increased as part of the COVID stimulus to $150,000, and it also broadened the scope for taxpayers who are large business entities with a turnover of up to 500 million. Since then, we've now had another update in the October budget, which has essentially allowed all businesses to deduct the full cost of depreciating assets, including large businesses with a turnover of under 5 billion. So it's important to note that these turnover thresholds, these are worldwide turnovers. So they include your foreign connected and affiliated entities. So if you've got foreign parents or foreign subsidiaries, those turnover amounts need to be included in this assessment. Now, only just announced this week, the Treasurer has come out and said that large businesses in Australia who have foreign and related entities with turnovers, they can now be excluded. So you now just need 5 billion of Australian ordinary and statutory income. So that has essentially opened up this concession to an even broader range of our largest corporate taxpayers. This slide here is just showing, so for some of our clients who adopt the small business depreciation pools, these are the changes to the thresholds here in line with each announcement. So essentially now you can deduct the cost immediately following the announcement on the 6th of October. We don't see these being used as much in practice, but I'm conscious that there are some small business entities out there who use this. Now, it's worth mentioning that the ATO have acknowledged the interaction of these concessions and their impact on the loss carryback rules. So there is an opportunity here for clients to you know, consider your capital expenditure and how that could create a tax loss for you in a particular income year, and then how that could then feed into your loss carryback claim if you're eligible. So the next point here is the Next 5000 program, which is the latest program being rolled out by the Tax Avoidance Task Force at the ATO. The purpose of this is ultimately to provide the community with confidence that that Australia's largest privately owned and wealthy groups are paying the right amount of tax. This is an extension from previous programs, previously known as the Top 500 program. It does now extend to privately owned and wealthy groups of a wealth of more than $50 million. So the ATO uses certain data matching and previous returns and the like to assess whether a business will be caught under this review program. The ATO will essentially come out and assess the significant activities or events and transactions that have been undertaken by the private group over normally 2 income years, but we have seen recently with some of our clients that the review has been extended to up to 3 or 4 income years. The ATO's key methodology in undertaking these reviews is the concept of justified trust, which is an OECD concept, which essentially builds and maintains community confidence that taxpayers are paying the right amount of tax. Now, there's 4 key pillars that the ATO use to assess justified trust. The first one is governance. So one of the first things that the ATO will ask to see in one of these reviews is your corporate governance framework or policy documentation. So we're currently working with a number of our clients in getting these frameworks in place, knowing that the ATO will eventually, as part of this program, contact them for a review. Now, this documentation essentially outlines tax return processes, the roles and responsibilities of management and the board, as well as how are they implementing these policies once they're in place. Second thing they focus on is tax risks flagged to market. So essentially what the ATO want to do is prove that the risks that they've flagged during the last few income years are not present in the taxpayer's business. So for example, a key risk flagged by the ATO currently is transfer pricing. So they will come out and want to review your transfer pricing documentation and assess if there's a risk. New and significant transactions. So this essentially is the ATO wanting just to understand your current business activities and any significant or new transactions that have occurred during the review period. So that can include a focus on business acquisitions or disposals. Finally, they'll want to review the book to tax reconciliation. So this is the ATO wanting to understand how a taxpayer has moved from your accounting profit or loss recorded in the accounting financial statements and how that correlates to the taxable income or loss reported in your income tax return. So here you can see just a bit of a roadmap of how the ATO undertakes these reviews. So what we're seeing currently is the ATO will send out a notification directly to our clients. Historically, this has come through the tax agent, but we're finding them wanting to reach out directly to the business and the management within. First up, you will receive a letter and then a request for information. Now, under the first sort of roadmap that you'll see there, that request for information is very broad and essentially covers all key areas of tax that the ATO would consider as part of a review. Now, what we're finding for many taxpayers is that a lot of this is not relevant. However, you're still required to go through the documentation and collate a significant amount of information for the ATO. So it can take a significant amount of time. As you'll see there, there's ongoing discussions with the ATO throughout the process, and potentially could take up to 8 or 9 months to get through a review. The second box there is a transitional option. Now, this is dependent on taxpayer circumstances, but the key difference here is to refine the scope of the review up front with the ATO, and then you'll receive a more appropriate request for information, which is more applicable to your business. Now, the ATO is seeking to progress these options where appropriate. However, in practice so far, we're finding that the ATO is primarily taking the first option. So there's my details there. Feel free to reach out to me or any of my colleagues in respect to any questions on tax, and we'd be happy to help. So I'll pass back to Ash to close out.
Great, thanks, Gav. There were some very useful and relevant insights there. So apologies everyone for running over time. As we've gone past 10 a.m, we won't go through the questions that we've received, but we will respond individually over the next couple of days. So thanks again to everyone for joining our webinar today. Please reach out to myself, Kay, Aletta, Gav, or anyone else at BDO for any further questions. I hope you have a great day. Thank you.